Holdings Berhad is a Southeast Asia's consumer group that was founded by John Fraser and David Thomas Neave in 1883. FIN Holdings is a subsidiary company of Fraser and Neave Limited that headquarters in Shah Alam, Selangor, Malaysia, and has a business presence across Southeast Asia, the Middle East, and Africa. FIN is the world's largest manufacturers and distributors in the region, with leading brands such as 100 Plus, FIN Farm Flavors, FIN Seasons, FIN Ice Molten, Teapot, and other famous brands. Dutch Ready Meat Industry Berhad is a leading dairy company in Malaysia, established in 1968 in Petaling Jaya, Selangor. The company is subsidiary of Friesland Campina, one of the world's largest dairy cooperative. Dutch Ready Meat Industry Berhad became the first meat company to be listed on the KLSE on 34th September 1968. The company markets their product under various brand names such as Dutch Lady, Dutch Baby, Freezer Lad, Freezer Go, and Dutch Lady Pure Farm.
In this part, I will briefly explain the SWOT analysis for FIN's and Dutch Lady Company. Particularly in the beverage industry, FIN's robust and reputable brand name is highly recognizable product that significantly contributes to the company's success. It maintains a significant global presence in over 30 countries with more than 70,000 workers. Despite FIN's considerable success, it does possess specific weaknesses. The FIN company offers a diverse range of beverages, with around 400 varieties available. Most of these items are unknown and never accounted for sale, potentially impact their marketability. As for opportunity, FIN has partnered with prominent companies such as Grab, Lean, and Ranji to introduce a pilot project in Malaysia with an AI-powered reverse vending machine, or VM. This project aims to promote increased recycling among customers and foster long-lasting, sustainable transformation within the country. Although FIN company has market dominance, it nevertheless faces many threats. Many individuals are consistently attempting to change their dietary and beverage preferences. Certain products offered by FIN's may lose customers. This could affect the sales of FIN's company. Moving to the next part, I will show you the SWOT analysis for Dutch Lady. The Dutch Lady company possesses a substantial market share and a remarkable reputation, which are undeniably strengths of the company. In addition to its extensive distribution network, which comprises over 100,000 retail locations and more than 150 distributors, Dutch Lady supplies consumers with over 1 billion meals products annually. While Dutch Lady has several strengths, it's important to note that every company has weaknesses. Dutch Lady's product line is prominently centered on dairy products, which can be considered a possible weakness. This could pose vulnerability in the case of a shift in consumer preferences toward non-dairy alternative or substantial transformation in the dairy business. With the rise in global population and urbanizations in Malaysia, there is anticipated growth in the demand for dairy products. This presents a positive opportunity for Dutch Lady to expand its market share. The high cost of raw materials can constitute a significant threat to Dutch Lady, as they can negatively affect the company profitability and general financial health. High raw material costs can decrease Dutch Lady profit margin unless the company can offset these expenses by rising product prices and passes on the additional cost to consumers.
Additionally, I will elaborate the common size analysis on income statement. As you can see, the Fraser and Neave company able to generate more profit from the total revenue because it can generate 8.55% of net profit in 2022. However, though the company is able to improve the sales rapidly, it's still lacking of cost control. The company may need to focus on cost management strategies to improve its profitability. This could involve identifying and reducing unnecessary expenses or improving operational efficiency. Next, I'll continue to explain the common size analysis on statement financial position. From the 100% of total asset for year 2022, Dutch Lady Company has more current asset as compared with Fraser and Neave Company. It means the operating activity of Dutch Lady Company can be considered healthy and indicates that the company has enough liquid assets to cover its short-term debts. Additionally, from 100% of total liabilities and equities, Dutch Lady Company has higher liabilities than equities. As compared with Fraser and Neave Company, the company's total liabilities is much smaller. It means the financing activity of Dutch Lady Company may indicate a higher financial risk and potential financial distress. All in all, we can conclude that Fraser and Neave Company has better performance than Dutch Lady Company. It is because Fraser and Neave Company relies less on debt financing, which can lead to lower interest payments and reduce financial risk. Hence, lower total liabilities generally result in lower financing costs, as the company has less debt to service. This can also free up cash flow for other investment or operation. So I will explain about ratios of both companies. Firstly, these liquidity ratios provide insights into Dutch Lady Milk Industries Berhad and Fraser and Neave's company ability to meet its short-term obligation. Both current ratios of company has improved significantly, showing that the ability to meet its short-term obligation. In this case, Dutch Lady Company has more favorable liquidity position since average collection period is only 27 days compared to Fraser and Neave Company 71 days, showing that the company is taking quite fast time to collect payments from its customers. For the activity ratio, Fraser and Neave Company able to to turn over its inventory into sales approximately 4 times during the year compared to Dutch Lady Company 5 times during the year. Fraser and Neave Company has more favorable position as it indicates that the company is efficient in collecting payments from its customers as it is able to turn its account receivable into cash almost 7 times during the period. For leverage ratio, the debt ratio and debt equity ratio of Dutch Lady Company is much higher than Fraser and Neave Company in the year 2022. It means that Dutch Lady Company was exposed to high risk and they were more dependent on leverage. All in all, the Fraser and Neave Company has considerably favorable position since the company's debt ratio is much lower, hence it has stronger equity position. Next, overall, both companies' profitability ratios declined from 2020 to 2022 as due to increase in sales, but all expenses resulting into lower net profits. However, Fraser and Neave Company managed to gain higher net profit margin, which is 8.55% as compared to Dutch Lady 3.45%. So, both companies need to focus on cost management strategies to improve its profitability. For market ratio, Dutch Lady Company has higher price earning ratio as compared to Fraser and Neave Company, which means Dutch Lady Company may find it easier to raise capital through equity financing as investors may be more willing to invest in the company. In this case, Dutch Lady Company is generally considered a better company as it indicates that investors are willing to pay a higher price for each of the company's earnings.
First of all, we will examine the revenue. Dutch Lady has shown consistent revenue growth throughout the analyzed years with an increase 90.28% in 2022 compared to the base year 2019. Similarly, FNN has also experienced a positive trend in revenue, although at a slower pace, and a significant 8.47% increase in 2022 indicates that Dutch Lady has experienced significant growth every year than FNN, especially in 2020. Then, Dutch Lady's net income drop of years in 2020 saw a significant increase of 240.87% in 2021, followed by another major decrease 44.94% in 2022. Meanwhile, FNN's net income has slightly decreased over the years but has remained stable. In comparison to Dutch Lady, the drop from 90.98% in 2020 to 93.19% in 2022. Dutch Lady's fluctuations in net income are more noticeable compared to FNN's, suggesting possible challenges in handling expenses or market changes. Over the period of 2019 to 2022, Dutch Lady experienced consistent growth in their total assets compared to the initial year. This upward trend suggests positive investment. Similarly, FNN also saw an increase, although at a slower rate than Dutch Lady, which are 0.46% to 19.60 since it has obvious increase in derivative financial assets. Overall, Dutch Lady's total asset growth was more aggressive due to an increase in intangible asset as well as prepayment. On the other hand, trend index in relation to liabilities, Dutch Lady has witnessed a consistent rise in liabilities over the years, with a remarkable rise from 100% in 2019 to a stepping 149.52% in 2022. On the contrary, FNN has displayed a downward trend from 83.43% in 2021, before experiencing a slight uptick to 123.79% in 2022. The increasing debt of Dutch Lady may be borrowing more to fund expansion or investment opportunities, whereas FNN's decreasing debt indicates a cautious and wise approach to managing debt sheet. In conclusion, overall FNN's performance is better, even though it may not be growing rapidly, but it is still improved due to its focus on consistently increasing asset and equity. Then it shows that the company's effort to control the cost while Dutch Lady's net income fluctuates significantly.
In conclusion, overall, from the comprehensive financial analysis that's been done, the result reveals that FNN is a better performance compared to Dutch Lady. It is because FNN has better in controlling their costs that result in better balance between revenue generation and cost management. And also, FNN have lower repayment obligation because of their capital structure that they have more capital in equity compared to liabilities. Our recommendation for Dutch Lady in terms of their cost control, the company need to regulate new budgeting and negotiation and other strategy aimed at managing expenses throughout the business activity. Not only that, as they have a high capital structure in them, Dutch Lady can convert those debt to the common share that make their creditors to become part of their shareholders and owner of the company. From there, it will reduce the repayment obligation to the creditors and at the same time reduce the interest expenses that resulted in deducted of net income of the company. And last, for FNN, the company might have a better performance, but it seems that they need to have an improvement for the future growth, in which they can reduce the dividend payout ratio and reinvest in the business. From that, the company needs to buy back the shares and increase its value of the company. Therefore, the company can use retained earnings to invest in R&D, expand operations, or acquire new assets that will help the company grow and increase its profitability in the long run.